Good evening. Thank you for joining us tonight through our Wealth Creation Through Real Estate webinar series. We have a new episode every fourth Monday of the month, providing free educational content so you can be a more informed passive investor. Tonight's webinar is a 128 unit multifamily value add case study. I'm Gary Lipsky, president of Break of Day Capital, and our other host is Kyle Mitchell, managing partner of Limitless Estates. Our companies work together to provide passive investment opportunities for busy people. We focus on acquiring multifamily real estate investments that offer value-add opportunities. We look in growing markets for undermanaged assets to maximize investor returns. Next month's webinar is an SEC Attorneys Panel, How to Stay Out of Jail. The link to sign up will be in the chat box, so make sure you register now. Also, if you'd like to schedule a call with either Kyle or myself, you'll find links there. A little bit about me. I've been investing in real estate since 2002 and went full-time into real estate in the beginning of 2017 after selling a business I owned. I've personally invested passively in over 1,500 units before I started syndicating my own deals, and I still invest passively. Currently, I have 170 units under management with Kyle, and we run a Phoenix meetup together. I also run a few other meetups in Los Angeles as well. I know a bunch of you that are on tonight's webinar have attended some of our meetups before, and if you haven't, we'd love for you to join us in the future. I have started a nonprofit for underserved youth. I've been involved in a business mastermind group, and I've run several businesses, which gives me that critical business operational experience necessary when you're asset managing a property. All right, let me turn it over to Kyle and let him tell you a little bit about himself.
Perfect. Thanks, Gary, and thanks for everyone for hopping on. I'm Kyle Mitchell, managing partner of Limitless Estates, and as Gary mentioned, we both own and operate 17 million of assets in the Arizona markets. I am the co-host of the weekly real estate podcast, Passive Income Through Multifamily Real Estate. I am also the principal of multifamilymasters.com, which is a group of meetup groups. We have about 55 chapters nationwide and also 2 internationally. And we focus on educating people in the multifamily space. And I am the host of 2 of those, one here in Los Angeles and another with Gary in Phoenix. And I have about 15 years of experience in operations and management. And I like to show this slide here because a lot of people ask me, how did I get started in real estate or multifamily real estate and become a lead sponsor right away? And really my background is what separates me and allows me to do that. On the left there, you'll see a picture, and that's at Brookside Golf Course in Pasadena. It borders the Rose Bowl stadium. And what our golf course did, which most golf courses do not, is host the Rose Bowl and the national championship game when it came to the Rose Bowl on a yearly basis. So what you see there are pictures of tailgates that I operated and was in charge of. And what those were 20,000 people in each of those tailgates that we served. And on those days, we had as many as 900 employees that I had to hire. We had to appoint leadership to each of their stations. We had to train them, implement systems. And so my background is in training and management and operations. On a day in, day out basis, I managed about 250 employees, 20 million in revenue, but also on top of that, I had these games to kind of manage and oversee. And because of that, you know, what I did was I was a regional manager for a golf management company, which is very similar to a property management company for a apartment building. It's just a different asset class. So as I mentioned, my background was in hiring, operations, management, implementing systems, managing budgets, and so on.
All right, so we'll jump in. So this is the original landscaping and monument sign when we first bought La Casa. So as you can see, you know, it's got one demographic that they're marketing to. You know, you can't really see the property at all. You got these on the right side, you see this one tree, and on the other side, You'll also see some trees that really block the monument sign when you're driving by. It's a very, very busy road. So that was, when we saw this, we're like, oh, this is a great opportunity for us. Let's go to the next slide. So here, these are great pictures from a professional photographer. Nice blue skies, kind of looks really, really nice. But again, we when Kyle and I see a property like this, we see opportunity. So on the picture on the left, there's a huge wall opportunity for banners or whatnot to market the site, and they weren't there. And you'll see at the end of our webinar, we put some great banners there for marketing for the site, and that saves on dollars that we have to spend elsewhere, because it's not a recurring fee. We make the banner once and it's up there. And then on the right, you'll see this kind of a good sized playground, but there's not much to it. So we'll get into it later, but we see, when we look at this playground, we see opportunity. Let's go to the next slide. So when we start walking the units, you'll see, there's just a top left picture I'm looking at is just one color. So what we always like to do, Kyle and I, is to have an accent wall. And that accent wall doesn't really cost much, but it adds a lot of pop to an apartment. And so when someone's, we're looking to increase rents, that is more dollars for us in our pocket and for our investors, when we do these little extra touches. And obviously when you look at the kitchen, it's pretty drab. There's no backsplash, white appliances. There's no pulls on the cabinets, and that really goes a long way. Certainly you can paint this or whatnot, but for these types of apartments, we like to do brand new cabinets, have the shaker doors and whatnot, and really have that kitchen pop. And that's how you get those $200 to $300 rent bumps that we're looking for. And then on the bottom left-hand picture, you'll see, a bathroom, pretty drab. Again, that screams opportunity for Kyle and I. So the opportunity here, branding towards one demographic, which I had mentioned.
Gary, none of us can hear you right now. Gary, are you there? Okay. Can someone hear me? Can someone from the chat box? Okay, perfect. I'm going to go ahead and continue since Gary cut out there. So like Gary said, branding towards one demographic, we like to typically brand towards multiple demographics. There's nothing wrong with the demographic that they are currently appealing to, but you want to have multiple sources of marketing. And so changing the name is one thing that we're going to do so we can make sure that we're branding towards other demographics. Property management company, it's geared toward a smaller property. So this property management is actually someone that we know, and they manage a couple of other of our partners' deals, but their deals are smaller than 50 units. When you get into the 100+ unit space, you really need infrastructure, staffing, training programs, and things like that. And this property management company who currently had it did not have those things in place, and therefore they just were not managing this property very efficiently. So our plan was to bring in a professional third-party property management company who specializes in Class B and C product at 100+ units. Little to no increases. The story behind this property is that this was a syndicator themselves, and they're at the end of their business plan. And the market in Phoenix and in many markets was so good over the last 4 years, they did not even implement half their business plan because they didn't need to. So they only did 19 of the 128 units as far as the interior upgrades, and left the rest for the next investor. So there was a lot of meat left on the bone for the next investor because their business plan was only probably 25-30% executed because they didn't need to upgrade the units. Limited amenities. We're not adding too many extra amenities, but we do plan on bringing this to a B- class property. And so we are going to add a couple of amenities. We added a business center. We are going to do the parcel pending boxes just to give it a little bit better feel. And really where we're adding them is at the leasing office. So that's the first thing the residents are going to see or actually the prospective residents are going to see when they walk into the property, when they go lease and tour the property. This is in a growing submarket, which we'll talk about in a little bit on another slide, but this area is growing year over year, and the Phoenix market in general has been fantastic. And this is a true value add play. There's a lot of properties where the broker will tell you that something is a value add, but it's been sold 3 or 4 times in the last 4 years, and there's only $25 in rent increases available as far as what they call a value add. So you really got to be careful when you're looking at value add. This one is true value add. We're going to be able to save on the expenses. We're going to be able to bump up the rents $200 to $300 per unit, and only a small percentage of the units are under or have been renovated. I think Gary's back, so I'm going to let him take over on this slide here.
Yep, sorry about that. Internet dropped off. But so I kind of talked about a little bit about the business plan already, the interior upgrades, upgrading the leasing office, and you'll see pictures later. So, when you walked in, that first impression you had was not a good one. It was a tiny waiting room with a desk in there, and there was another office, and then an open space for residents to use. But it looked really drabby. It wasn't impressive, and that's so important on our properties, that we want to have that pop. When someone comes by and is looking to rent a place, their immediate first impression is, wow, this is a place I want to be at. We'll also add a barbecue area and dog run where that playground was. So we're going to actually divide that area in half and just add more amenities for our tenants. And that, again, allows us to get the rent premium that we want to get. We'll improve that roadside landscaping. We'll have pictures at the end. So we cleared a lot of that landscaping. So 1, you could see the property, and 2, you could see the monument sign and any other signs that we want to put out there. We're going to fix the deferred maintenance, so roofing, so that'll cut down on our expenses as far as fixing leaks, stuff like that. AC units will also, they would overwater landscaping. So just a lot of little things that they weren't doing that we're going to take care of. We'll also increase other income. We added RUBS, and that is tenants will reimburse us for water, trash, stuff like that. As we discussed, we're going to hire the third-party property management company, Shelton Residential. We also partner with them on our Tucson property, and they have been fantastic. Expenses is so important. At the end of the day, when we look to sell this property, you've got to increase that income, and you've got to reduce the expenses. So we have an expense management plan in place. And let's go to the next slide.
I'll go into this one, Gary. Thank you. So this is the business plan by the numbers. On the left-hand side, you'll see the average rents pre-renovation and then what our post-renovation rent goals are. And you can basically see a difference of anywhere between $200 and $250. The 1-bedrooms were at $757 on average. Our goal is to get them to $1,025, and the 2-bedrooms were $900 with a goal of getting them to $1,200. And that does not include the RUB increase as well. So when we took over this property, it was an all utilities included property. We're slowly implementing RUBs of $40 and $55. One thing I'll say about RUBs is you really need to make sure that the market charges RUBs at your at your competition. If you're the only one in the area charging RUBS, then it's going to be tough to get away from that or get away with that. So it's something you definitely want to take a look at when you're doing your comps and making sure that your competitors are adding and charging RUBS and what they're charging. The goal is to put in about 1.4 million in capital improvements, and I'll walk through some of the items there on the right-hand side. But the goal is when we go into a property, we want to tackle deferred maintenance on day one or as soon as we can. The reason behind that is because deferred maintenance is creating a lot of day in and day out expenses on your P&L. And if you can tackle those, that's the quickest way to reduce your expense ratio aside from just increasing the rents. So there's a lot of things that can be done, whether they're plumbing leaks that need to be done, the roofs needed to be done that are causing some issues, some preventative maintenance on the HVAC units that will allow us to save those units for longer periods of time and not have the day-to-day expenses. Those are some of the items that we're tackling right away. So T12 expense ratio is 47%. Our goal is to go to 41% in year one, and then year two, 36%. So for those of you that invest in the East Coast and Midwest, you may be looking at the expense ratio and saying, holy cow, can you get it to that number? In Arizona, yes, there's a couple of things that really impact that expense ratio number, and I'll go through those. Number one is taxes on the expense line. In Arizona, the most that taxes can be raised year over year, unless you're doing ground up construction or completely rebuilding, is 5%, right? And there are markets out there where the taxes can double upon purchase. So taxes do not get reassessed upon sale in Arizona, which is one of the many reasons why we like this market. So we only need to budget for a 5% increase. And so that's one of the reasons why the expenses can stay so low. The other thing is that the insurance is pretty low in Arizona. We probably pay between $175 to $200 per unit. There's other markets out there that are well above 300 because they have natural disasters that Arizona would not otherwise. So other than that, rent growth is another thing that can bring down your expense ratio. And rent growth in Arizona and Phoenix in general has been number one in the nation for, I think, 2 years running now. So their year over year rent growth was about 8% last year. So all those things combined, you are seeing stabilized properties with expense ratios in the 30 percentile. I would say, though, that you do need to be careful with that and always double check. But if you're underwriting as a rule of thumb of 50% in Arizona, you're really not getting anywhere. And you've got to know your market. And that's one of the things that, knowing your market, you can underwrite to those items. Over to the right is the renovation budget. Total cost per unit is $11,000, but we are spending about $17,000 per unit on the interior renovations because we're adding washer and dryers. That's our big play here, is adding washer and dryers to get our rent premiums. They did a nice job on the 19 units that they did. They just didn't add washer dryers. That's our that's kind of our separator. So, but we're only doing 71 of those interiors. We're going to leave some meat on the bone for the next buyer. And so there'll be 38 units that have not been done for the next buyer to come in. And that's why the blended average is only 11,000 and not 17,000. So there's some other things in here. I won't go through all of it, but the thing I wanted to point out is the bottom four items. So HVAC replacement, roof repair, fire system reserve, contingency. These all are all reserve items, over $300,000 sitting in reserves only to be used when they need to be used. So this is not money that is planned to be used, but this is our kind of rainy day type of reserve account just in case we need to go dive into it. And I think, especially now in today's market, it's extremely important to have that reserve fund going in and not utilize any cash flows for that.
All right, location. Hey, by the way, I'm seeing some great questions. Thank you. We're going to address them at the end, and make sure you put them in the Q&A and not the chat. But I look forward to answering them towards the end. So we love the location of originally it was called La Casa of East 3434. Near on this picture you won't see it, but it's right above the airport, the 10 freeway, 51. not too far from 202. So a lot of freeways right around that property, which is fantastic. Not too far from Scottsdale and Tempe, which are Class A neighborhoods. This is a Class C neighborhood, but potential to be Class B in the coming years, and that's when the returns really skyrocket if that happens. We really didn't underwrite for that to happen, but we did. We do feel that the neighborhood has got tremendous potential. Actually, an apartment building right down the street, E-class, nicer and much more amenities, did sell for $173,000 a door, where we bought ours at $118,000. So again, Maricopa County, which Phoenix is in, has been the #1 growing county in the U.S. the last 2 years as far as population. It's the 5th largest city, actually moving closer to the 4th largest city, and it's still one of the most affordable ones in which to live, and that's really important. So many people from the West Coast are moving to Texas and Phoenix to live so much cheaper with lower taxes, good quality of life, and that's what Phoenix is about. Tremendous population growth over the next 5 years. You're talking about 6.6%. We underwrite it for 3% the next 5 years, which is pretty conservative. We always want to underwrite conservatively because you never know. You can't predict the future, and you want to have safeguards for what could happen. And that's also when we're having long-term debt as well. That if we can ride out a storm if necessary. If you go to the website weareapartments.org, Phoenix needs 150,000 new apartments by 2030, and new construction is not keeping up. So that's a huge advantage for us as well, knowing that there isn't pressure to decrease our rents, and there's actually a lot of room for us to increase rents. New construction is definitely happening and picking up some steam in Phoenix, but they just can't build enough to keep up. As you can see, the submarket average rents have increased 11.55% year over year, which is huge. Whenever you're analyzing a property, you really need to look at that submarket, not just Maricopa County or Phoenix, but what's happening in that general vicinity. And Kyle and I will walk every single apartment building within that radius. Across the street, pretty much, is a brand new charter school, which is great for families that are looking for a school that they could send their children to and get a great education. So that's a really big opportunity for us. There's also a huge lot a few blocks away that they're going to be building something as well. I don't know what it is going to be. We have called and inquired. But they said it was they couldn't disclose. But we're really excited about whatever they build there will benefit our property. All right, so wins and challenges so far. So when I mentioned that charter school across the street, when we bought it, we didn't know that was gonna be there. But man, they built that thing really fast, so we're really excited. I mentioned Indigo Palms. That's sold for 173 unit. Our exit on our pro forma, we had it at 168 a unit. So there's a lot of work still to be done at East 34, but we feel pretty good. And then we also took over the property with 98% occupancy. We were not expecting that. We knew that there's going to be quite a bit of turnover in the beginning. Because of tenants that might not have been properly qualified to live there. And as you're turning units and rehabbing them, you're going to have some vacancies. So that gave us some really nice padding. So we were able to be well above our pro forma for the beginning when we took over the property. With any property, it's not all wins. I wish it was, but there are some challenges, and parking is one of our biggest challenges, quite honestly. And we're trying to work on some different solutions, and it still remains an obstacle for us. The spots are tight. As you can see, there's no more space to build more parking spots. We tried to work with the neighbor, and that hasn't worked out so far, but we're still working on that. We may not have a solution, quite honestly, but there's no property that's perfect, and if it was, we'd probably have to pay a lot more money for it. So other challenges, like I mentioned, some credit unworthy tenants. So when we took over, a lot of people were paying towards the end of the month, and so we kind of, over a couple months, we moved them to paying on the first of the month when it's due. And we've made, I give a lot of credit to our property management company, and they've done a wonderful job of retraining the tenants. And some we've had to evict. They don't, in Phoenix and Arizona, you don't have to wait months or years like in California. You can start the process after 5 days, which is great. So if people aren't paying their rent, we can find tenants that will. And permits. We started getting our washer dryer permit in the very beginning of October. And our property management company almost laughed at us. They're like, well, why do you want to start so early? And, we sat down with them many times to go over the business plan, make sure everything was aligned. And, Kyle and I, when we take over a property, we want to, jump out of the gate right away. So we wanted to have those washer dryer permits right from the beginning. But quite honestly, it's taken many months to get those permits. We're just getting them now. I think we've passed all the obstacles that they threw at us. So we'll finally be able to install them and get rolling. But a lot longer than we expected. But I'm glad we didn't wait. And we started well before we closed on the property. Sometimes that happens, but you got to deal with it. Let's go to the next slide.
All right, so these are some of the pictures of our renovated units, and you will see a washer dryer in there because we did do one test unit. So this is more along the renovations that Gary and I like to see. It's a huge difference. I will say one thing about the renovations. You do have to make sure that the sub-market can handle the rent increases and the renovations. You can over improve. However, based on the comps in the area and knowing that there's 3 or 4 other syndicators in this actual area that have just purchased and they're putting renovations into their properties as well, we know that this level of renovation is needed in order to hit our rent bumps. And we're hoping that we can actually get another $50 to $75 in addition to what our target is. So brand new cabinets, stainless steel appliances, granite countertops. Although we originally were going to go with Formica, our property management company has a lot of buying power, and they were able to get the granite countertops for cheaper than the Formica. And granite countertops are going to stand up a lot longer than the Formica, and so we went with them. Backsplash and brand new flooring, baseboards, washer dryers, and you can't see them in these pictures, but we've got all new fixtures as well. So pretty sharp looking unit. And this is pictures of our leasing office. So I wish we had pictures of before that we still need to get, but before, this picture on the left, that was basically the area where the manager would sit or the assistant would sit and take new clients. And it was a very tight space, not very welcoming. You can see in the back left, that's where the manager was sitting before, but that's the new leasing person right there. So as you walk in, we now have a waiting area. We have some nice modern art, which is fantastic. And the property looks really nice. And then if you see in the back left, there's a door back there. We opened that up, or we actually added a wall there, and that's where the manager now sits. The next picture is just the other angle of that sitting space. And then the picture all the way to the right is the business center. We haven't added the computers yet. They're on order, but that's a business center for the residents to use. And it's a good little space for them. We were going to add TVs, but it is a pretty tight space, so we decided against that. But overall, new, modern, clean, updated, much more spacious, and much more welcoming. As Gary mentioned before, this is their first impression, and you want to make it a very good impression. And before it really wasn't. It just was not a place that you would want to be. And this is some pictures of the front. If you remember, the front was completely blocked with palms and bushes and things like that. So it's very difficult to see. This road has 27,000 cars going by it on a daily basis. So we want to make sure that we're hitting them in the face. And so as you can see with the new sign, it's bright, inviting. You can see it from the street. We've got banners on the road or on the sidewalk. And then over to the right, these banners are humongous. I'm not even sure. I think they're 10 by 20, and they're on each side. And they're not really meant to look, it's not meant to beautify the property. It's meant to grab someone's attention and say, hey, we're leasing, we've got washers and dryers. Since we've added these signages, our walk-ins went from 0 to now getting 5 to 8 walk-ins a week. So this has been really beneficial to us, and those are the people we've been really able to lease up from. So this has been a huge win for us. And that's it. We have a bunch of questions that we're going to try and get through all of them. We appreciate everyone hopping on, and I'll go ahead and start doing the questions right now. I do see a lot of questions coming into the chat box. We will get to those as well, but if you can move those over, or not move them over, but if you can ask any questions in the Q&A, we'll go ahead and answer them there first, and then I'll move over to the chat box. So starting with the first question here, what's going on with the parcel right next door? Is there planned multifamily development? So that's a great question. Actually, Gary just talked to the owner, is actually playing phone tag with the owner of it right now. We are possibly looking at making an offer on that piece of land, or at least finding out what's going on with it. We've heard that they've had multiple offers on it. It's not zoned for multifamily, so there is no multifamily going on over there, but we do think it's an opportunity. We do like the area. And so we are going to inquire about it, but we do not know what is going on, but we are reaching out to the owner. Next question is, what is T12 expense ratio? So T12 expense ratio means the trailing 12 or the past 12 months of the expense ratio. So what you get when you're looking at a property is you ask for the financial statements, or the T12, and that's what that is. It's the trailing 12 expenses and income. And so it gives you kind of a snapshot of how the business has been running in the past 12 months. Let's see. I see that you plan to drop your expense ratio by 100 basis points in 2 years. What are you using for your expense growth assumptions post year 2? We typically use a 3% year over year expense growth assumption. The reason why we're able to drop it so drastically, we actually didn't mention this, is we did a Fannie Mae Green program, which is a energy savings program. So what that is we're putting in all LED lighting, and we're also putting in low flow fixtures into the units. And in order to get the discount that we did on the interest rate for that program, you have to save 15% in water and 15% in electricity. And the way that works is the lender will send someone out, they do a full report, and then you get to pick and choose which items you're going to do from that list. And so much of that expense ratio as well is utility savings. And I just answered that one. Let's see. Gary, if you want to answer some of these, just let me know.
All right.
Were you able to amend existing leases to add the RUBS, or as leases turn over? So this one, yep, go ahead.
You wouldn't amend an existing lease, but when they renew, that's when you can add the RUBS, and any new leases, then we would implement the RUBS as well. So that's $55 times 120 units times 12 months. That's a huge increase to our revenue. All right. Please elaborate further on how you will be reducing your expense load from 47% to 36%.
I think I already answered that, Gary.
Yeah. So deal sourcing, really good question. Thank you. So this came to one of our partners on the deal, and he has a full-time job. He worked with a broker in the past, so he sent it to Kyle and said, hey, take a look at this. And Kyle texted me during that day. He's like, "We're going to Phoenix tomorrow morning," and I'm like, "All right, let's do it." So we drove. We left, by like 4 o'clock in the morning. Got there by 9 a.m. We were one of the first people to see that property. It was just going on market that day, and we made a preemptive offer. If you're winning a property through best and final, most likely you're going to overpay. And Kyle and I, we see a lot of deals. We underwrite a ton of deals. We make offers on the ones that make sense. And when you get to a best and final on some of these, you're gonna lose. So we made a preemptive offer that we thought was a fair offer, and one that worked within our numbers, and we were able to get the deal done. Certainly it wasn't easy along the way. There was some, back and forth with the buyer and us, but so to answer your question, on or off market, it was basically on, but we were able to get a head start on others, which was a huge advantage. Kyle, you want to go from there?
Yeah. So next question: median income to in-place rents ratio. Median income in this area. So median income in this area is about $36,000. The reason why we love this area is because two years ago it was $20,000, and so it's increased dramatically over the last 2 years. So this area is starting to really grow. So the ratio, 35,000 divided by into 1,200, but I don't know what the ratio is exactly, but the median income in that area is 36,000. Is there an upcharge for pets? Yes, there is an upcharge for pets. That's one thing when we do due diligence, is that our property management company makes a note as we walk through each of the units, and then cross-references with the lease to make sure that they're being charged for pets. There were quite a few people that were not being charged for pets. So what we will do is go back and notice all those residents and let them know that they need to be paying pet rent, which we're doing now. So those are some small items that do add up over time. If there's 10 or 15 different units that are not paying pet rent, we charge $35 a month plus a non-refundable $200 deposit. So those definitely add up. When was your planned reno completion date again, and when were you going to stabilize rents to projected levels? So this project is estimated to take about 18 months from start to finish for the renovations of the interiors. The exteriors, we had a goal of 90 days. It's probably going to be about 120 days when we're done with all the exterior work, which is what we want to focus on first. But the plan was 0 units in the first month and then 6 units per month going forward, naturally turning over just with natural vacancy, not forcing people out. So the renovations are already underway. The lease ups are already underway. The one biggest challenge that Gary mentioned was that we didn't have the washer dryer permits. So we have not been able to test the market rents with washer dryers. So we're getting close to market rents right now, but not the market rents that we want. Once we're able to add the washer dryers in, we do feel confident that we'll get at or above that number. How is this property performing when you found it? That's a difficult question. I guess that's subjective. I mean, it depends. It was performing extremely well to the previous owner compared to what his budget and plan was, but when we looked at it, there was a lot of opportunity from a management standpoint, a guest experience standpoint, a rent standpoint, and an NOI standpoint. So I would say it was underperforming for sure. But again, that's subjective because the seller had already accomplished his business plan or his numbers, and in his mind, it was performing very well. What tools are you using to do rent surveys? So we rely pretty heavily on our property management company to help us out with the rent surveys, but they use CoStar. We also use CoStar. I would say that CoStar is not the greatest because it pulls comps that are not really comps, so you do have to pay attention to that. Some of these comps that CoStar pulls may be 5 miles away or 4 miles away, and that's just not a comp. Maybe that's the same amenities, but that doesn't really matter. So you got to be careful with that. What Gary and I do is we drive comps. We will call the comps and we make sure that they're charging what, you know, the website says they're charging, and we'll walk through and we'll secret shop them and we'll walk the units, take pictures of the units. And that's really how we do our rent surveys when we're in the point of due diligence and really digging in. Before that, we heavily rely on our property management company and get their feedback as well.
And we have one more question, Kyle, in the chat box. Did you stress test the numbers and, you know, talk about that, what we did there?
Yeah, we always stress test. It's one of our things that we just, you know, you have to do it when, especially in this point in the cycle. So we do a break-even analysis. So we want to know what the property is going to be performing at if we were going to break even. You know, what would the occupancy be if we broke even? What would the rents be if we broke even? And then we also do an IRR analysis as well. But that break-even analysis allows us to see where we're at. And, you know, I can't remember the exact numbers off the top of my head, but the break-even analysis stated that the occupancy, I believe, need to be above 75%. And in the downturn, you know, Phoenix was at, I believe, 85 or 88%. So we were well within our range and felt very comfortable after stress testing.
All right, we got one more question here. If you guys have any more questions, don't forget, put them in the Q&A and we'll tackle them. All right, how far are you pushing rents towards the max in the area? Excuse me. We aren't pushing max towards the max. You know, we want to get occupancy up and then get our washer dryers in, and then we can start pushing it up. But it's a C-class apartment building, so we're gonna measure it against those other C-class apartments in the area and see what their rents are. And every week we have a call with our property manager and see where our rents need to be. It's not something we do on a monthly or quarterly basis, but every week we're kind of measuring what's our occupancy, how many units did we get leased up. So we're constantly monitoring it. I mean, even our Tucson property that's been stabilized for a while, every single week we talk about pushing rents and where do we need to be. And then once we get the rehab done and getting our occupancy up, then we can kind of keep pushing.
Yeah, Gary kind of hit it there, but you know, when you're taking over a property, your business plan is forever changing. It's not a set in stone business plan. Nothing goes exactly according to plan. So you need to pivot and move things up and down. And it's a weekly discussion right now because we're in the we're stabilizing the property, right? So for the next 18 months, it's the most important time. Once we're stabilized, these conversations will likely not be as frequent, because we'll have stabilized rents, our loss to lease won't be so high, and we'll know what our market rent is. But right now, we're making sure that you balance occupancy with pushing rents while staying to your budget. And so that's the thing that Gary and I are going through right now.
So I think that's all the questions. Again, if you'd like to schedule a call with Kyle or I, please do so. Don't forget to sign up for next month's webinar on March, let's see here, March 23rd, Monday. We're gonna have a great legal panel. And if you guys have any suggestions in the future, please let us know. We thank you again for joining us. You've got our contact information if you'd like to reach out. And we'll see you next month. Thank you.
Thanks, everyone.